Welcome. You are listening to Purpose-Driven Wealth, the podcast for empowered investors. If you're an investor who is tired of playing the Wall Street casino, stay tuned. On this show, we bring on industry experts to discuss leading strategies to help you make empowered decisions with your hard-earned capital. And now, here is your host, Mo Bina.
Welcome to Purpose-Driven Wealth. I'm your host, Mo Bina. Today on the show, we have Rob Napolitano. After getting a full understanding of the inefficiencies of the banking system, he founded Grit Partners, which now helps people grow their wealth. Rob, welcome to the show.
Hey, Mo. Thanks for having me. I appreciate you taking the time and giving me some time on your show here. Appreciate that.
Thank you for coming on. Thank you for coming on. Really appreciate it. Rob, well, why don't you start us off by kind of talking about your background and why you founded Grit Partners?
Oh, so that's a story that goes back 20-something years ago. I started 20-something years ago as a real estate investing, and I had my own mortgage bank before the great financial crisis happened. I was in mortgage banking, had my own mortgage bank. I was closing $40 million a month in loans, and was doing really well. At that time. And I got my first experience of a downturn when the great financial crisis happened. You know, you're making your income, got good pipelines, spending money. I was single at the time, had a good life, and the great financial crisis comes and pulls the rug out from underneath me and kills my entire pipeline. I got to a point where, the phones weren't ringing anymore, deals weren't closing, banks were clawing back some of these loans. And it was a dark time. It was really interesting when the phone doesn't ring anymore and how quiet and how loud silence can be during those times. So I learned that really well. Didn't like it at all. I saw how the banks were going into foreclosure and started doing some nefarious stuff with illegal foreclosure. If you remember the robo-signing scandals that was going on, right? And who had the note and all the stuff and everything. And I was, really well versed inside of the mortgage banking system, that I started a litigation support company where I went to law school to become a paralegal, because I knew there was going to be a lot of lawsuits going on, and there's going to be things that need to be unwound. And I felt that I could be a really good asset inside of the legal system. And so I started a legal support company. I was accredited in 11 states bar associations, giving continuing legal education to attorneys on how mortgage-backed securities worked and how foreclosures worked. And we actually got cited by the state Supreme Court of Massachusetts with one of our briefs on one of a major case up there. So we did really well with that. The challenge with that was I wasn't making any money and I wasn't surviving doing that. So it got to a point where, I couldn't pay my bills. I was being labeled as a deadbeat. And at that point, I just met back then my current wife. Now that we're married 14 years. So I had just been meeting her and wanted to, keep her because she was a really good woman. And I was deadbeat, lost all my money. I went into a Chapter 13 bankruptcy at that point. I was like, wow, what a way to start a relationship. But thankfully enough, 14 years later, she's still with me. I actually filed for bankruptcy, Chapter 13 bankruptcy, 2 days before we got married, lost it all. And I had my attorney at that point, and I told him, I said, you know what? The last 2 foreclosures that are going on in my life, the banks are not doing them properly either. And I want to go and fight this, and I want to pay all of my creditors back, everything that they're owed. But we're going to actually see what they're owed, because what they were doing, their system was set up in a way where they don't lose. Bankers never lose. And part of the trick is they have ways of either offloading their losses to somebody else or insuring their losses, so much in a way that they never take the loss. They always pass the buck. They keep the profits and get rid of the losses. I thought it was genius. It's like, why can't we all do that? But so I fought back. I said, if they got paid, and here was really my theory, if they got paid 60 cents on the dollar for the money that I owed them, then why should I pay them back 100 cents on the dollar? I shouldn't pay back the remaining 40. Why are they using me as a way to double dip? And so we put forth a couple of very clever theories that were very based in simple logic, in front of the court, and the court started saying, yeah, this is true. Why are you double dipping on this guy? And we started getting into the mortgage-backed securities. We wanted them to open up the trusts. We wanted to see who all the investors were in the back end, all the accounting. I mean, I was going after them. And it got to a point where they were like, okay, we don't want to set any precedent. This guy is really going to be a pain. So why don't we just pay him and let him go away? It got to the point where they paid off all of my entire bankruptcy estate. All my creditors got paid. They paid it. They paid all of my legal fees. And on top of it, I walked away with a big fat check. And so with that, I actually started my first fund in 2014 buying mortgage notes, because what they put me through and when they put people through, when they're going through the foreclosure process, how inefficient it is and all this money they're making, there's no accountability, and how abusive the system was. I said I want in on that game, not only to make money, but I knew that I could make it better because I can buy these loans at big discounts from the banks. And so I can help the banks clean their balance sheets because they only like those clean and unimpaired assets. I could then be the bank and help homeowners stay in their homes by modifying their mortgage payments. So I'm helping the economy by keeping homeowners in the homes. And then I can help other investors looking to get into this business park their money next to mine and help them become wealthy doing it the same way. So I've been doing that since 2014. After I became actually one of the few people you'll ever meet that actually went into bankruptcy at a certain net worth and actually came out at a higher net worth. So, but what I found, the biggest value I got out of that experience was I learned how the banks play offense and defense at the same time. So I knew that this time when I built up my pot of gold, I knew that I was going to do it with offense and defense, and it's made all of the difference. And so from there, I've started another fund with insurance, life settlements, and now we've kind of rolled them all up into Grit Partners, where Grit Partners now is my company that offers access to distressed assets in real estate and life settlements to act as a risk mitigator, a risk buffer. And so going after distressed assets, my offensive play, using the insurance as my defensive play has made all the difference in building what it is we're doing today. Because the real purpose behind all this is, we're living in a world today where leadership and big thinkers are taking things in a direction that are making a lot of people not happy. Okay. And it is infringing upon people's freedoms. And what I mean by that is this: freedom is really an extension of our lifestyle options. As we move up that economic ladder, the more lifestyle options we have, the more choices that are available to us. And that's that freedom, right? The freedom to come and go as we please, to think as we want, to buy things, travel, do all these things that we want to do freely without anybody encumbering the way we do things. And that happens as you move up the economic ladder. And through no fault of our own, through inflation, spending, and all of these other things that are going on, mostly fueled by excessive debt, our ability to move up that economic ladder is being encumbered. And so that's why doing what we're doing now, we have a philosophy called us capturing tomorrow, that our tomorrow is being robbed from us. It's being robbed from our children. One of the best things that came out of all this experience, now I'm the father of two great children, and I have a responsibility and a fiduciary to my children to capture their future. And that's what I do with all my partners and my investment partners that want to capture that tomorrow. You do that by grabbing some of these assets at a discount today, making a difference, and building a better tomorrow, not only for homeowners, but for your legacy as well. So I know it was a little long-winded, but that's the whole purpose and mission that I went through what I went through, which was a dark time, but it served me to be as a blessing in disguise. And so now we're out there, just making it better for everybody that we can.
Oh, well, that was well said. Very beautiful. Love to hear that. And I love the part especially about the freedom as well too. It's there are powers out there that more and more are increasingly trying to take away our freedoms and our ability to do what we want, say what we want. And so it's a lot of people don't understand. They just voluntarily think that, oh, well, it's probably for some greater good. But at the end of the day, if you look throughout history, giving up individual rights and freedoms and sovereignty have usually not led to good things.
Yeah, well, it depends. It hasn't led to good things for the citizenry. It's led to good things.
Person.
That's right. It's led to good things for those that are trying to continue to cling and expand their holds on power. It's led to good things for them. And a lot of this, see, what a lot of people understand too, that a lot of this is fueled by debt. See, a big misconception we have today, people are talking about, oh, we're going to have an economic downturn and tip into a recession. That's not the biggest issue we have today. The biggest issue we have today is that we're taking on too much debt. See, recession is when we have a downturn in production in this company. Our production is good. I mean, the GDP, that's production is good. The challenge is that we're taking on too much debt and our production can't keep up with how much debt. It's as similar as people who have a job and have a W-2 job. They can only get so much income. If their credit card debt and all their mortgage debt and all their auto debt outpaces their income, they're insolvent. And that's the challenge that we have here. Not that the income of the country and the GDP of the country is a problem. We're taking on too much debt. And so we're not going to go into an economic downturn because of GDP and income and a recession. We're going to have to go through a deleveraging process because the debt burden is becoming too big, which is different. So it'll be some pain we're going to experience, but it's going to be a little bit different from a recession.
Yeah. And a lot of people probably don't realize that in order to keep our economy moving, it requires us to have to go further in debt just to even get economic output and economic growth. So
that's exactly right. And so what'll happen is that some of the citizenry is going to have to give up lifestyle options while others are going to gain more power. Right. And that's where you're really seeing that equality and income gaps that are coming into play, where we're having these gaps in society. And you have a lot of this divisiveness, because all the divisiveness that we hear with the saber rattling in the news, that's just distraction for what's really going on. Mm-hmm. And what people really seeing that, that their pocketbooks are becoming lighter and lighter and lighter. And going back to the other point too, who tells us about this stuff? The financial advice that we get out there today, that traditional financial advice out there, they don't talk about any of this stuff. The traditional financial advisors are just putting everybody, just go into stocks and stay long. That's not advice. You got to really understand what's happening. And that's why, as well as you, we love these alternative ways of investing, because they're traditional ways of doing things. That's just old and passe. We're going to go through alternatives are going to be the way through, and we're going to get into this, survival mode people have to get into, and alternatives are the way to do it, not the traditional way. There'll be a time for traditional equities again when we get into this move through the cycle and get back into the phase of prosperity, but not in the phase that we're going through right now. Alternatives are going to lead.
What are your thoughts on risk? That's probably something that enough investors don't give enough thought to when they're evaluating an investment opportunity. How do you kind of tackle the understanding, identifying, and mitigating the risks involved with a particular investment opportunity?
That's a great question. It's one of my favorite questions, because I believe it's a topic not talked about enough. And going through what I went through, again, remember what I said, that I was making money, back then. My pipeline was full. I had all this money. It was all good, but I didn't plan for the unknown. I didn't plan for that. I knew that we could go through cycles, that the great financial crisis was going to come, and all those powers that you have no control over. So that caught me off guard, and that got me thinking a lot about risk. And then that's what I said. So when I went through my bankruptcy and everything I went through, I came out looking for the risk first, play defense first, and then offense. So I came out looking at it a lot differently. I didn't have defense in my playbook at all before that. But now I look at the defense first, and I study risk. And look, risk, it can be measured. It can be measured, and some define it as, the probability of loss, the probability and the likelihood of loss. So let's back up and try and make it simple as possible. Why do we care about risk? Simple. We don't want to lose money. So there's 1,001 ways to lose money, and there are maybe out of 1,001 ways, maybe 700 of them, we know what they are, and 301 we have no idea exist out there. And my point is that there are things we can control and things we can't control. And so when we talk about risk, we have to look at it as the conversation of risk is never going to be all encompassing, because there are things, like we said, geopolitical risk. No one's going to stop the Fed from printing more money, not you nor I, but that's a risk that takes away our ability to build our wealth. Okay, it's there. What can we do about it? So that's why I started looking at when we're buying these impaired assets and you're buying them at big discounts, that's the way you get ahead of this. It's by outpacing the rate of wealth erosion. All these risks where we lose money erodes our wealth. So we can come up with ways and systems to outpace, not eliminate, because you're never going to eliminate risk. You have to mitigate it or offset it. And so if our rate of loss of our net worth can be outpaced by our rate of gain, okay, then do we care about risk? As long as, yeah, we still care about it, of course. We want to make sure that our rate of loss still stays lower than our rate of gain. And one of the best ways of doing that is not by, again, going into traditional markets or bonds where you have these low yields that aren't even keeping pace with real inflation. It's by buying these things at a discount. Where, what if you could buy Apple stock today at $25 a share, buying it at a big discount? Everybody would jump on that today. That's kind of what we're talking about, buying assets in today's world at 1980 prices, let's say. That's what you want to do. You want to try and go back into time and try and pick up things at a certain price. And that's what you can do when you're buying these distressed assets. You're buying them at yesterday's prices, today's assets at yesterday's prices. And that, while you can talk about risk all day long, the different risks, one of the ways is to outpace it. And honestly, that's why, so those are the things you can control. The things that you can't control, that's why we started doing the life settlements. Because we use the life settlements as the insurance against the risk that we take, those that are known and unknown. Because the way a life settlement works, there are many abandoned life insurance policies out there that are used for key man policies, key employees, generational wealth transfer, asset protection. There's all sorts of reasons that life insurance are used. And there's the consumer market as well, why people buy life insurance for their own personal reasons as well. But there's many reasons why they get abandoned. And so they get sold at a secondary market. It's a very well-established secondary market. And you can buy these policies at big discounts as well. And there's not much to do with it. There's very little overhead. And when an event gets triggered and the policy matures, you're just getting a lump sum of cash for doing nothing other than keeping premiums up. So if I can keep those premiums up on the one side, and that can help offset some of the risks that I've taken, or some of the risks that I don't even know about, so that it can offset some of the losses that I've taken. That's how I've designed our system, that we can insure against the losses and the risk. I don't think enough people do that, play enough defense on how to offset some of the risk of loss. I think it needs to be talked about more. So it's a great question that you asked.
Yeah, you'd mentioned about the life settlements. So for listeners that probably aren't really kind of in tune or aware, it's a very niche investment, first of all, right? I've vaguely heard about it, here and there over the years, but are we essentially talking about life insurance policy in the case that in the event that somebody dies, whether it be, because you kind of mentioned like key person as well. So it could be like a key management personnel of a company, or it could be a family member. And so in the terms of like a family takes out a life insurance policy on a father or mother or some family member. And essentially then you'd said like these policies also trade on an exchange, or they trade on a secondary market. So can you kind of get into the details of what a typical life settlement policy kind of consists of? And then you'd mentioned also buying at a discount, like what type of discount are you usually trying to aim for when you buy these types of policies?
Yeah, so I'm not the expert on this, because I've got great partners in this. When I started to do this, my expertise is on the banking side. And the one thing that I knew, that banks and insurance companies basically rule the world, right? Anything we do is because banks say so, or insurance companies say so, and they have the attorneys that kind of make the rules for all this. And this is why I went from the real estate side into the banking side, because you want to own nothing and control everything. And you do that with debt. And that's what banks do. And then they insure it with insurance companies. So banking and insurance always goes hand in hand. And that's why I wanted to build my company with banking and insurance. But there is no insurance for us as private real estate investors to do this. So I had to go out and find it. So when I found my partners that I have now, we wanted to build this. Life insurance has a very similar characteristic of what I was looking for. So they're very similar to buying notes, where you're buying a future payout at today's discount. It's a financial instrument. They're both financial, and I call them cousins. A mortgage note and the life insurance policy, I call them cousins. They act very similarly, especially as asset classes. They're not correlated to the interest rate market and not correlated to a lot of other risks, but they're very similar. It's a financial instrument. They both have an imputed value at face value, mortgage note and an insurance policy. You're buying them at a discount, and at some future point in time, it's going to come to maturity and you're getting paid, right? And that's the game, is measuring when it comes that the payment is coming, and what's securing it, and what does it cost to keep it going all along. The difference between a mortgage note and a life insurance policy, though, on a mortgage note, I can actually get payments over time on a monthly basis. Whereas on a life insurance policy, I've got negative cash flow, whereas I'm paying premiums either a monthly, quarterly, or on an annual basis. Okay. But there's good and bad in both, right? Because the life insurance policy, let me back up before I say what I'm about to say. As investors, our ultimate goal is to make money with the least amount of risk. And one of the ways we calculate that is time value of money. So we can make money in the least amount of time with the least amount of risk, then we're golden. And that's the goal, is to get to the least amount of risk in the least amount of time with the most amount of upside. And that's the balancing act, and that's where all the risk and everything comes into play. So I've never found anything that monetizes time. But life insurance policies monetize time. And here's what I mean by that. I can buy a life insurance policy, and they're not all the policies are the same. We go through rigorous underwriting. We have a particular buy box on how we do this. But let's say we take $1 million policy, and let's say I can buy it for 35 cents. We'll go for a third, 33 cents. Okay. And whatever the premiums are going to be, we have to measure out, we're going to pay $330,000 for it. Let's call it $10,000 a month. And I'm making up numbers. Okay. Just for the sake of the conversation. Let's say it's $10,000 a month. For 10 years, we'll say, is the estimated payout on this. We're into it for what? That puts me at $450. So $450, I get $1 million, I double my money, and whatever the return ends up being. Okay. But here's the thing. I buy the policy in year one. So if my hold is going to be for 10 years, the life cycle is going to be for 10 years. In year two, I can go back out and sell that policy. And I can sell it for more than 30 cents. Here's the reason why. Because I'm closer to the finish line. I'm only 9 years out. 2 years later, I can sell for even more money because I'm only 7 years out. So as we get closer to the maturity of the policy, the more valuable it becomes. And guess what I've done to that policy over the course of that time, other than paying premiums? Nothing. It sits in my drawer. So time is what accrues in value.
So this is kind of like the opposite of an option, because as you get closer to the expiry of an option, it actually loses value. But in the case, this is the exact opposite, right? As you get closer to the end, right, to the terminus, then it actually increases.
That's exactly right, because I can go trade it right back out, because again, now we've shrunken the time value of money there, because I'm closer, I've shrunken my term in which I can get paid. So I can, it's got more value at that point. So by sitting in my drawer, it gains more value. So while it sits in my drawer, it gains more value, protects my net worth. I can go out and go do on a daily basis my notes, my real estate, and all my other stuff, and all the other risks that I take. Because if you got a pool of these things sitting around just accumulating value while it sits, what am I worried about? Less and less and less. So that's one of the best characteristics of the life settlements, is how it monetizes time with no overhead, very little overhead. It's one of the best investments out there when we're trying to grow our net worth, especially what we talked about before. If we want to put these systems in place where we want to outpace the rate of inflation, the rate of our loss, and all this stuff, this is a great instrument to put into your portfolio because of your gain on it with the very little overhead and time input. It sits there and it just grows for you. Okay, while you have the time to go do everything else and get all your other investments going as well. So, and that's why I say it acts as a volatility buffer. It acts as a risk mitigation tool, or even dividend protection. Sometimes we've called it as well, or even a credit enhancement, right? Because if let's say I did this. I know I'm talking a lot and fast, but my brain goes that quickly. Let's say I said to you, Mo, Mo wants to invest $1 million with me in my company, and I said, Mo, here's what we're going to do. I'm going to take 600,000 of it, and I'm going to go buy a distressed asset. We'll buy $1 million mortgage note at 60 cents on the dollar, and I'll take the other 400,000 and I'll buy a $1.5 million life settlement policy as well. Now I've bought what is that, $2.5 million worth of value for your $1 million. Now let's say my mortgage note is a complete flop and failure, and I lose all of your money on the mortgage note. Do I really care that I've lost your $600,000 if the life settlement's going to pay $1.5 million? Right? I've lost you nothing then. I've really lost you nothing. You're not going to like me that I lost you $600,000. We may not talk again. We may not be friends anymore. But in the end, I didn't lose your money because the insurance policy covered your initial investment and then some. So that's why we call it as a risk mitigation tool. But now, what happens if the 600,000 primary investment that we did does hit and the life policy pays off as well? That's when we call it a credit enhancement, because for your $1 million, I've now given you back $2.5 million. So not only does it act as a risk mitigation, but if the primary investment goes well too, now your life settlement is a credit enhancement where it pays you even more and enhances the yield and enhances your rate of growth. So it's got these characteristics that really play well. Again, but the underwriting is going to be done right. The buy box has to be done right. It's got to be, it's very tricky and meticulous in how you buy these particular policies the right way, because they have to line up with the risk that you're taking on the primary investment side.
Interesting. And so how do you work with investors? And are these products, are they essentially bundled into like a fund, or are they specifically pieced together for individual investors?
So I try to help as many people as I can as we go through time. And unfortunately, not everybody, has their interests aligned or their values aligned with what it is that I do. And so I've got a couple of pathways for people. I want everybody to capture their own tomorrow for themselves and their children. I want them to become brilliant at doing it. But the way you go about that, everybody's got a little bit of a different way. So I've got 3 ways that I do this with people. I do, I come on shows that are, like yours, and I try to help and give as much guidance and advice as I can. I do my own stuff on LinkedIn where I'm doing some free trainings. I'm doing webinars for free. And we have a lot of educational stuff that people can come by and just, at their own leisure, consume it at their own leisure. Because some people want to do it themselves, and they're going to want to learn and do it themselves. So that's fine. We got that path for people that want to go and do it themselves. There are other investors that come and want me to do it with them. And we have an advisory service where they can hire us so we can build their empire for them as they see fit to capture their tomorrow. And then there's a third one for those that want us to do it for them. We have a couple of funds where they can park their money next to my family, and they will get the benefit of the decision-making that we do for my own children. And if their interests are aligned, they can apply for that. That's got to go through an application process to park their money with ours. But if they qualify and come in, we can do it for them within our suite of funds as well. So we got those 3 paths: those that want to just learn and do it on their own, those that want us to do it with them, and then those that want us to do it for them. But no matter which path they take, we strive to get everybody to be brilliant at doing their own legacy planning and capturing their own tomorrow.
Oh, nice. One last question before we end. You kind of mentioned about, like, for example, on the life settlements and how you get closer to the end and, the value increasing. How do you figure out when is an appropriate time to sell? So like if the value went up by year 2, well, isn't it going to go up even higher by year 3 and year 4,
Sure.
year 5? There's got to be some point where you've kind of, let's say you've gotten most of the meat off the bone, or you've maximized, the return as much as possible without having to hold, longer and longer that particular life settlement policy. How do you kind of figure out when is a good time to exit?
That's a good question. Luckily, I have good partners where we have committees that make these decisions. And it's not necessarily based on one factor. Where are we in the environment? Where are we with liquidity? Again, geopolitically, where are we going? For instance, why would anybody sell real estate, in an uptime as well, right? We just did a 1031 exchange. I'll give you a perfect example. And it may be happening out where you are as well. Okay, I have family up in New York that owns significant holdings in real estate. What happened when we went through COVID? All the tenants were given permission not to pay the landlords, but none of the landlords were given permission not to pay the banks up in New York, right? So all these different things, like we said before, that risk that come into play will drive decisions. Do we just go ahead and say, this is the one we want to sell? Or again, it could be so many factors that go into the decision making. Luckily enough, I have a great team that we put our heads together as a committee to make those decisions when, where, and how. But there's not one particular factor that goes into play as to why we would sell. But the fact that there is a market there and we could sell, that's what really attracted us to the asset itself and making it part of our portfolio.
Mm-hmm. Rob, how can people find out more about you and Grit Partners?
So I have a pretty good presence on LinkedIn. That's where I like to hang out. I don't do much on the other social media platforms. I do some stuff on YouTube. I'm putting some more stuff out there so they can get me on LinkedIn. The Real Rob Knapp is my handle on LinkedIn. Or they can just email our team. They can email us very simply. If I want everybody to become brilliant at capturing tomorrow, so we start with actually them putting it in writing. So they can email us at brilliant@capturingtomorrow.com. Once they put it in writing, that's their first step to becoming brilliant at doing it. So anybody can reach out to us at brilliant@capturingtomorrow.com or just find us out on LinkedIn. Happy to help people to do what it is they need to do to capture their own tomorrow as well. This is just an example of how we're doing it and helping many, many people out there do the same.
Great, beautiful. Love to hear that. Rob, thank you for coming on to the show today.
Mo, I appreciate your time. This was a lot of fun.
Yeah, thank you so much. I enjoyed it as well too. And thank you for sharing all your insights with the audience as well. And that's all for today, everyone. Thank you for tuning in, and until next time, have a great week.
Thank you for tuning in to this week's show. If you are interested in learning how alternative investments can help you build purpose-driven wealth, sign up on the High Rise Capital website to receive our monthly newsletter and free investor ebook. Lastly, if you enjoyed this episode, don't forget to subscribe and leave a 5-star review. Thank you for listening to Purpose Driven Wealth, the podcast for empowered investors.